In 1754 BCE, a Babylonian king carved 282 laws into a 4-ton stone slab. Most people know it as the eye for an eye code, but buried in those ancient laws was something revolutionary, the world's first attempt at shared risk. Law 238 said that if you borrowed money for a sea voyage and your ship was destroyed by a storm, you didn't have to pay it back. Sounds simple, right? But this single rule would eventually grow into the vast modern system of risk sharing that protects everything you own today. But to understand why this law was so revolutionary, you need to understand just how deadly ancient trade really was. Imagine this. You're a Babylonian merchant in 1800 BCE, and your family's survival depends on a single wooden ship crossing the Persian Gulf. But you know there's a real chance it won't come back. Your wife knows it, your children know it, and you definitely know it. Yet here you are, watching your life savings disappear into the hull of a vessel that's basically a few planks held together with tar and hope. Ancient sea trade was a death trap wrapped in potential riches. Storms could sink ships in minutes, appearing without warning across the Persian Gulf's shallow waters. Pirates roamed these same routes, ready to steal cargo and eliminate witnesses. Navigation relied on stars and prayer because maps were crude sketches at best. If clouds covered the sky for days, you were sailing blind into waters that could dash your ship against hidden rocks or leave you stranded in the open ocean until your water ran out. The math was brutal. Stay poor and safe on land, or risk everything on voyages that could make you wealthy beyond imagination or leave your family destitute. There was no middle ground, no safety net, no backup plan. A single voyage often carried a merchant's entire life savings because that's what it took to buy enough goods to make the journey profitable. You couldn't afford to send half your money. The profit margins weren't there. Without forecasts, merchants relied on monsoon season knowledge. Get it wrong, and the sea could claim your ship. Trade routes carrying luxury goods were essential for civilizations to thrive. Spices, precious stones, and exotic materials could only be obtained by crossing some of the world's most dangerous waters. These weren't optional luxuries. They were the foundation of economic power. Kings needed gold for armies, priests required incense for temples, and wealthy families demanded silk to display their status. The human cost was staggering. Families waited months without knowing if their loved ones were alive or dead. Entire communities could be wiped out economically by a single storm season. When trading expeditions failed, it wasn't just a business loss. It was a social catastrophe that impoverished families and left cities struggling to pay their debts to neighboring kingdoms. Here's the economic paradox that haunted ancient civilizations. The very goods that made them wealthy required someone to risk death to obtain them. But convincing people to take these life-threatening risks when failure meant total financial ruin was becoming impossible. How do you encourage trade when the consequences of failure are so catastrophic? Traditional lending made the problem worse. If your ship sank, you still owed the money plus interest. This meant that even surviving merchants could return home financially ruined, creating a system where success was rare and failure was devastating. This deadly gamble was strangling the ancient economy. Commerce was grinding to a halt as fewer merchants were willing to take risks that could destroy their families. The situation demanded a revolutionary solution that would change everything. King Hammurabi wasn't just carving laws into stone. He was performing economic surgery on a civilization that was bleeding money from failed sea voyages. While most people remember him for an eye for an eye, Hammurabi was actually solving a much bigger problem: how to keep trade flowing when merchants were too scared to risk their lives and fortunes on dangerous journeys. This wasn't your typical ancient king who just wanted to punish criminals and collect taxes. Hammurabi ruled Babylon from 1792 to 1750 BCE, and he understood something crucial about economics that many leaders missed. Babylon's prosperity didn't come from farming or mining. It came from being the crossroads of ancient trade routes. If merchants stopped sailing, his entire kingdom would collapse. But here's the challenge he faced. How do you write a law that protects merchants without encouraging reckless behavior or bankrupting the people who lend them money? Traditional lending made the problem worse. If you borrowed money for a trading voyage and your ship sank, you still owed every copper piece plus interest. This meant that even surviving merchants could return home financially ruined, owing more than they could ever repay. The system was creating a death spiral where fewer people were willing to trade, which meant less wealth for everyone. But buried deep in Hammurabi's code was a secret clause specifically designed for seafaring merchants, something that would change everything. Hammurabi's solution was Law 238, and it was revolutionary. The law stated that if a merchant borrowed money for a sea voyage and lost the ship to forces beyond his control, the debt was canceled entirely. Not reduced, not postponed, completely wiped out. This might sound like he was just being generous to merchants, but it was actually calculated economics that would transform how trade worked. For the first time in history, risk was being shared between the borrower and the lender, rather than falling entirely on the merchant. Think about what this meant. Lenders could no longer just sit back and collect guaranteed interest. They had to carefully consider which voyages to fund because they might lose their entire investment. This made them partners in trade ventures rather than just creditors collecting payments. But here's the sophisticated part. The law only applied to losses from conditions beyond a merchant's control. Storms, pirates, or other uncontrollable disasters qualified for debt forgiveness. If the merchant made poor decisions, got drunk and crashed the ship, or tried to cheat his way out of paying, the debt remained. Hammurabi was encouraging responsible risk-taking, not reckless gambling. The system worked because it addressed human psychology. Merchants were more willing to attempt voyages, knowing that natural disasters wouldn't destroy their families financially. Lenders were more careful about which trips they funded, leading to better planning and safer routes. The law created incentives for both sides to make smart decisions while acknowledging that sometimes bad things happen to good merchants. Hammurabi had created the world's first systematic approach to shared risk, the foundational principle that would eventually become modern insurance. But this ancient law would prove to have consequences that reached far beyond those wooden ships and desperate merchants. That ancient principle of shared risk spread far beyond Babylon's borders and wooden ships. The concept that debt could disappear when disasters struck beyond anyone's control became the foundation for every insurance policy you've ever bought, from your car coverage to your health plan. Merchants across the ancient Mediterranean adopted similar clauses, and over centuries, this bottomry concept evolved into formal policies we recognize today: fire, life, marine, and beyond. The core principle remained identical. Pay a small amount upfront to transfer the risk of a massive loss to someone else. What started as canceled ship loans became the mechanism that makes modern life possible. Think about your last insurance purchase. You paid a relatively small premium to avoid the potentially devastating cost of replacing your car, rebuilding your house, or covering medical bills. That's exactly what Hammurabi's Law 238 accomplished. It let merchants avoid the potentially ruinous cost of losing their ships and cargo. The mechanism has stayed identical for 4 millennia. The global insurance industry now covers risks that ancient Babylonians couldn't have imagined. Satellite insurance protects space missions worth hundreds of millions of dollars. Cyber insurance covers data breaches and digital attacks. Celebrity insurance protects famous voices and faces. Professional liability insurance shields doctors and lawyers from lawsuits. All of these policies use the same risk-sharing concept that Hammurabi carved in stone. But here's the twist. The same principle that once encouraged dangerous sea voyages now protects us from taking risks. Ancient bottomry loans made merchants more willing to sail dangerous waters because they knew natural disasters wouldn't destroy their families financially. Modern insurance often makes us more cautious, knowing we're covered if something goes wrong. The tool that once pushed people toward risk now helps us manage it more carefully. Even the language survives. Modern insurance contracts still include acts of God clauses that exclude coverage for certain disasters, using nearly identical reasoning to ancient Babylonian law. These exclusions reflect the same limitations that Hammurabi recognized. Some risks are too large or unpredictable for any system to handle completely. The principle works because it addresses fundamental human psychology. People are more willing to take necessary risks when they know that uncontrollable disasters won't destroy them financially. Whether you're an ancient merchant loading spices onto a wooden ship or a modern family buying a house, the math is the same. Transfer the risk of catastrophic loss to someone better equipped to handle it. What started as a solution to an ancient trade problem became the foundation for how modern society manages uncertainty. Every time you pay an insurance premium, you're participating in humanity's oldest systematic approach to shared risk. One that began with desperate merchants and a king who understood that sometimes the best way to encourage progress is to promise that failure won't be fatal. That single law carved in stone didn't just solve an ancient problem. It created the entire concept of transferring risk that now underpins modern civilization, from bank loans to space exploration. Without Hammurabi's bottomry principle, astronauts couldn't launch rockets, entrepreneurs couldn't start businesses, and you couldn't drive to work safely. Think about it. How many modern financial innovations are actually ancient solutions to timeless human problems? What other buried wisdom might be waiting in historical texts, ready to solve tomorrow's challenges? Next time you click Buy Insurance, remember you're following a 4,000-year-old bargain carved in stone. If you enjoyed this deep dive into history's financial hacks, like and subscribe to explore more.